You've probably seen SCHD popping up on every dividend-focused watch list. But lately, it's been acting a little weak. Today, we're diving into exactly what's happening with SCHD, why the weakness isn't necessarily a reason to panic. Let's start with the basics. SCHD is the Schwab US Dividend Equity ETF, tracking quality dividend-paying companies. It focuses on sustainability, strong cash flows, and consistent dividend history. This fund has been a favorite for conservative and income-seeking investors with competitive yields. Historically, it's shown stability even during market turbulence, compared to other dividend ETFs like VYM and DGRO. Interest rates play a huge role in investment decisions. When rates rise, bond yields rise, making a 3% dividend less attractive. Investors rotate out of dividend-paying equities into fixed income for guaranteed income. This behavior is classic capital flow. With the Fed hinting at a pause or cut in rates, analysts are watching SCHD closely. When rates stabilize, dividend ETFs regain favor. CHD has been priced at a premium due to its reliability. However, this premium has compressed, entering a favorable zone. Due to its fundamental strength, this pullback can be a strategic buying opportunity rather than a warning sign for investors. CHD is heavily weighted towards sectors like consumer staples, healthcare, industrials, and financials, which often perform well in uncertain markets. People still need groceries, medicines, and essential services during inflation, meaning SCHD's underlying companies are resilient. Scheme for companies with a history of dividend growth and strong financial health to ensure dividend sustainability. Investors can rely on SCHD for reliable income, as it's unlikely to cut its dividends even if prices dip temporarily. Weakness in the market offers a chance to accumulate SCHD at better prices, appealing for consistent returns and steady income. The best dividend investors buy when others are fearful, maximizing long-term growth potential. The ETF currently yields around 3.5%, which is above some broader market averages, but lower than extreme outliers like REIT-focused funds. The beauty of SCHD isn't just the yield, it's the combination of yield and stability. Year over year, the dividend growth rate has been around 8 to 9%. For anyone reinvesting dividends, that's a compounding machine in motion. CHD is primarily US focused, but many of its companies have international revenue streams, which adds diversification. CHD has weathered recessions, rate hikes, and volatility, showing consistency that matters more than chasing the latest tech IPO. At the end of the day, dividends compound, and that compounding drives real financial freedom. CHD is structured to minimize capital gains distributions, making it tax efficient for taxable accounts. Don't overlook this advantage. By reinvesting dividends in a brokerage account, you're allowing tax efficiency to enhance your portfolio growth while minimizing disruptions. Set realistic expectations. CHD is not a get-rich-quick ETF. It's a long-term wealth builder best purchased over time. Consider dollar-cost averaging, which smooths entry points and reduces emotional reactions to market volatility, enhancing investment stability. Compare SCHD to ETFs like VYM and DGRO. SCHD offers reliability and growth, making it a favorite for both new and seasoned investors. Weakness in a solid ETF like SCHD often triggers fear. Investors see it dropping and start questioning everything. Experienced investors know that temporary underperformance doesn't erase decades of growth potential. Focus on fundamentals, not headlines. Companies that generate cash, pay dividends, and grow earnings will eventually be rewarded by the market. SCHD gives access to these companies. Understand why it's weak, recognize long-term value, and consider using weakness as a chance to accumulate. Dividend ETFs like SCHD aren't about daily price action. They're about building a consistent income stream. Consider starting small, reinvesting every dividend, and holding with patience. Compounding beats hype. Remember, SCHD isn't just an ETF. It's a tool for financial freedom, if played smart and stayed disciplined. Always do your own research. Consider your financial situation and invest in a way that aligns with your goals. SCHD offers a blend of income stability and long-term growth that's hard to beat. Be consistent, patient, and strategic. SCHD's focus on quality companies with strong cash flows positions it well for long-term success. Its commitment to dividend growth and stability makes it a compelling choice for income-focused investors. Analysts expect that as interest rates stabilize, SCHD could start to outperform it then. Its emphasis on companies with solid fundamentals means consistent dividend payments for, particularly retirees. By automatically reinvesting dividends, investors can take advantage of compounding over time, significantly boosting total returns during flat price periods. This strategy helps mitigate short-term price fluctuations and focuses on long-term growth. SCHD's low expense ratio makes it more efficient compared to actively managed funds, retaining more income for investors. The importance of diversification within SCHD cannot be overlooked, with over 100 holdings spanning multiple sectors. This reduces single-sector risk while providing exposure to a variety of industries, cushioning against downturns. For investors valuing growth potential and income stability, SCHD can be an attractive portfolio addition. Many long-term investors continue to hold and reinvest dividends despite short-term fluctuations, which supports the fund's stability. Those who panic during market dips often miss the power of compounding dividends over time. Keeping a disciplined approach and focusing on the fund's long-term prospects is critical. Remember, SCHD is not necessarily a quick profit vehicle. It's designed for steady growth and income generation. If you found this deep dive helpful and want to stay updated on all things dividend ETFs and long-term investment strategies, make sure to hit that subscribe button. Share your thoughts in the comments. Are you currently invested in SCHD, or are you considering adding it to your portfolio? Stay informed, stay patient, and watch your investments grow steadily over time. Many investors focus too heavily on short-term price fluctuations. But dip in the market makes them panic, thinking the fund is weak. SCHD isn't built for quick wins. It's designed to weather storms while steadily paying dividends. Those dips are often opportunities. Many companies in SCHD are household names with strong balance sheets and a track record of dividend growth. They have survived multiple market cycles. One powerful tool with SCHD is dividend reinvestment. Every payment can be reinvested into additional shares, building a compounding effect. Reinvesting allows you to buy more shares at lower prices, accelerating growth when the market rebounds. It can turn a modest investment into a substantial portfolio. Another important aspect to consider is SCHD's sector diversification. It has strong holdings in sectors like technology, healthcare, and consumer staples. It doesn't rely on any single sector to carry performance. If one sector faces a downturn, the fund remains resilient. For example, if energy prices drop, the fund is offset by the performance of sectors like technology or industrials. This broad exposure is a key reason why SCHD has been able to consistently pay dividends, even during challenging market conditions. Looking back over the last decade, the fund has maintained a steady track record of dividend payments, even during market crises. Unlike riskier high-yield funds, SCHD prioritizes sustainable income, focused on companies with a history of increasing dividends. Market sentiment can swing wildly based on economic news, interest rates, or geopolitical concerns. It's normal to see short-term underperformance compared to other funds. CHD's strength isn't in chasing short-term trends. It's in consistency, income generation, and long-term capital appreciation. Periods of underperformance can actually present an opportunity to invest more at discounted prices, leading to higher yields on reinvested dividends. CHD's low expense ratio means more of your investment stays in the fund, compounding over time and enhancing performance. The difference between a low-fee fund like SCHD and a high-fee alternative can amount to hundreds of thousands of dollars in lost growth over decades. CHD's resilience comes from its emphasis on quality over flashiness. It doesn't chase the hottest sectors or unsustainable yields. Instead, it focuses on companies with strong fundamentals, consistent earnings, and a history of rewarding shareholders. This approach might feel slow compared to high-risk, high-reward alternatives, but this discipline allows SCHD to weather market downturns. For investors who understand that wealth is built steadily, patiently, and strategically, SCHD is a powerful tool. If you found this video helpful, hit that like button, subscribe for more insights, and drop a comment below. Remember, investing isn't about chasing trends. It's about building systems that pay you over time. CHD may be weak now, but for the patient and disciplined investor, it could be the gem you've been waiting for.